stranger things are happening, and not just on Netflix. We spend days coming up with 21 different forecasters in a new normal that is so bizarre that I've actually coined it as unreal estate. We've had collateral damage in 2022. Yes, the curse of the strong US economy. Every slide from here on gets more and more bizarre. Welcome to Real Estate Trends 2023. This is a data-driven, chart-heavy collection of eye-popping insights that will help you make money in a severe housing recession and identify opportunities that this housing recession has created. We are data scientists and we look at today's real estate market with a mixture of both amusement and disbelief, complete disbelief. But let's figure out why we feel that way. I must confess that I am actually suffering from whiplash. 2022 or 2021 was the single most profitable year in real estate history. Best for single family, best for multifamily. And from those heights, we came into 2022 and everything changed in an instant. And we now live in a new world, in a new normal that is so bizarre that I've actually coined it as unreal estate 2.0. There is an enormous amount happening, and all of it somehow affects real estate. We're going to tie it all together and make it easy for you to understand the impact on both multifamily and single family real estate. Our second section is going to cover the economic realities of inflation and interest rate to get you ready for our final section. Once you understand the full impact today, that final section, it's going to look at the future. Our economic forecast will show you how real estate is likely to perform in this weird environment. For those of you who don't know me, I am a quirky and opinionated data scientist and technologist who buy and build large projects. Our portfolio of 18 properties is worth $1 billion, and 900 data-driven and nerdy investors, hopefully like you, invest in our projects. Here's half of our portfolio. We invest in 8 different asset classes: multifamily value add, apartment new construction, single family built to rent, fourplex built to rent, student housing, built to sell townhomes, self-storage, and also flex industrial. So each of these asset classes, they teach us something different, and they've made us better at our job, which is to protect your investment. And we've gone full cycle 7 times on those projects with an overall IRR of 35% and average annualized returns of 47% across those 7 exits. Remember, past results, not a guarantee of the future, but our hit rate is generally getting better. Here are 2 value add projects, thank you, Anna, that we exited last year. So in each year, we've more than tripled the projected IRR returns. And here are another 2 projects where we more than doubled our IRR projections. And in both of these projects, we did something very unusual. We bought existing properties and then we built more units. We call these super value add, and they are a unique specialty of our company. And our investors love what we're doing. Here's Jennifer. She's a super experienced investor. She compares us to much larger companies with more projects, and she thinks that we come out ahead. And here's Dr. Pada. He's a general partner with lots of deals of his own, both as a GP, general partner, and as a passive investor. Check out his comments in orange. It comes down to true use of data to optimize results, and we are very, very good at that. And that's why Dr. Pada keeps coming back to us to invest. All right, we're done with thumping our chest. This also gives a few minutes for people to come on in. Let's get the boring legal stuff out of the way before we dive into all the good stuff. This is just a friendly reminder that this webinar is for educational purposes only. And just because I'm sharing my personal opinions and Anna's sharing hers, it doesn't mean that you're guaranteed to make a fortune in real estate. So do your own research, consult professionals. Remember that investing in real estate is risky stuff. And don't be shy at all to type in your questions. We will answer them at the end. And don't worry if you miss anything, because we'll be sending out a recording of this shindig, probably not tomorrow, but definitely by Saturday. All right. Please, please, please tell me that at least half of you get this joke. Stranger things are happening, and not just on Netflix. Because every slide from here on gets more and more bizarre, just like season 4 of my favorite show. And we start Unreal Estate 2.0 with the curse. Yes, the curse of the strong US economy. Wait a minute, Neil. Don't you mean the blessing of the strong US economy? After all, we've got a labor shortage of 4 million people, the second strongest job growth on record, and record low unemployment rate of 3.5%. We should all be feeling blessed, right? Wrong, because we're in the upside down, to use a Stranger Things term. Everything that was right in the world in 2021 becomes wrong. It becomes the curse if inflation's high. So in 2022, US stocks lost 20%. The tech index NASDAQ lost a stunning 33%, even though corporate profits are up 25%. And US homeowners are $30 trillion richer than they were pre COVID. Why? Because the era of super cheap money ended. And it cannot come back if the economy stays strong and inflation stays high. So bizarrely, everyone from a Wall Street broker to a bank CEO to a real estate syndicator, we're all praying for a weaker economy so we can get back on our cheap money cocaine drip. Feeling unreal yet? And in this upside down world, we all have to come to grips with two huge 800-pound risk gorillas that no one talked about a year ago. The first one, geopolitics. The chart on the left is from BlackRock. They're the largest asset manager in the world. Geopolitical risk was less than zero in 2018. But by the time we ended December 2022, it's the highest it's been for decades. The world is fracturing into competing blocks who hate each other but have to trade with each other. We see all kinds of problems with that. So we're going to dive deeper into that geopolitical risk and the mega trend impact that it's having on our profits. But before we do that, let's introduce 800-pound gorilla number two, labor force participation rate. BlackRock also points out that in 2008, 66% of the adults in the US wanted jobs. They wanted to participate in the labor force. Now, post COVID, we're down to 62%. According to ChatGPT, who clearly knows everything, a 1% decline in the labor force is 1.6 million people. So we've now lost 6.5 million working adults since 2008. And somehow we thought that removing 6 million people from the workforce wouldn't create wage inflation? I mean, how dumb are we? Let's dive deeper into that first gorilla, though, the geopolitics. 2022 had the second highest oil and gas shock since the 1970s. Putin's war took the inflation that was created by COVID supply chain issues and magnified it. Massive food inflation, massive energy inflation is everywhere in the world. And without getting into a red versus blue debate, inflation is not a US problem. Helicopter money didn't create our inflation. Supply chains did. Putin's war did. Dozens of countries that didn't print any money during COVID are facing inflation just like us. In fact, half the world, on the screen, half the world has double-digit inflation. Take a look at that chart on the right. As Americans, we love whining about half a year of 9% inflation. Anyone want to live in Zimbabwe, Lebanon, or Venezuela? Not me. I'll take the US. Political dysfunction and all. And a lot of that inflation, it's coming from energy. The world is now in the midst of the first truly global energy crisis, with impacts that will be felt for years to come. Now, the chart on the left shows how we are hurting the least of any country. In this chart, light purple is good. We are good. It's dark purple that's in trouble. Europe is in trouble. On the right, you can see that Europe's natural gas costs are up 6x in a year. Electricity, 78%. Total energy prices up 2x in 1 year. And while we've been seeing some relief at the pump in the US in the last 3 months, it's very clear that the relief is not going to last. Expect prices at the pump to go back up in 2023 because inflation, it's like that old Paula Abdul song, 2 steps forward, 1 step back. And the Fed knows. They really know that if inflation expectations become anchored, and they're at serious risk of doing so, by the way, we could be in for a decade of higher inflation because inflation is affecting every part of our economy. I've even stopped eating salad because now I have lettuce prices to blame. But seriously, we have a very narrow window to get inflation down before wages go up permanently. Yikes. Which is why it's so good to see the Fed with such a sense of urgency after having no sense of urgency at all. The yellow line is the change in the Fed funds rate in 2022. As you can see, the Fed is hiking rates faster than any time in recent history. It's a race for the Fed. It's a race that they have to win, or we're all in deep doo-doo. But all Fed races have consequences. They have collateral damage. We've had collateral damage. In 2022, total US household wealth dropped by a stunning $13 trillion. That's a lot of Benjamins. Keep in mind, though, that this still leaves household wealth, even adjusted for inflation, 10% higher than 2019. What about home equity? It's still massive at 71% of the market value of all homes. That's a lot of home equity. We're surviving and even somehow thriving in unreal estate 2.0. And do keep in mind that even with my gloomy prediction about oil prices going back up this year, overall the inflation picture is getting better. By the way, I love this movie poster. It's incredible. They even put the names of the Fed governors starring in The Return of Inflation at the bottom. Check it out. Anyway, while it's clear that US inflation has now crested, thank God, the big question is, will it get back to 2%? Because these Fed governors, they've clearly shown they don't give a damn about the stock market. It's down 20 to 33%. They don't give a damn about crypto. It's down 60%. But they do care about real estate. Just kidding. They don't care. It's down 3 to 12%. They only care about getting inflation down to 2%. And economist after economist is warning us it takes a long time to do that. So we will all be living with higher inflation much longer than we're thinking. So now this slide, it's absolutely critical for investors. So pay attention, everyone. Pay attention. This is going to blow your mind. All right. So you see that blue line? That's inflation. So over the last year, up and up and up. The red line shows interest rates, also up and up, but notice it much slower than inflation, right? Now this chart makes you think, oh no, rates in red are going up. Good times are over. I shouldn't invest. Worst mistake ever. Because as the title of the slide says, this is actually a very rare money minting opportunity because real interest rates are not up, they're down. Because if you take the blue line and you subtract out the nominal line, take the blue line, subtract out the red line, what you get is known as real interest rates. They were at -5% in Q3 last year. They're up to about -3% now. In other words, you're actually being paid 3% to borrow money today. Where 2 years ago, here on the chart on the left side, when every one of you wanted to invest, real interest rates were at 0. You weren't being paid to borrow. Today, you do get paid 3% to borrow. So borrowing money during high inflation at a negative real rate is always better than borrowing money when the real interest rate is 0, like it has been for years. Interesting, isn't it? You know who understands this? The US government. They know that the national debt evaporates as income taxes go up with inflation. If dumb politicians get it, why don't you? In other words, inflation is not just a wealth destroyer, it's also a wealth creator. As the cost of stuff goes up, the value of the dollar goes down. So inflation transfers wealth from savers to borrowers. And when inflation is high, that transfer, it's also faster. As an example, if inflation stays at 8%, you can see on the right here in green that stuff will cost 216% more in just 8 years. In other words, stuff will double in just 8 years. Shouldn't you buy that stuff now? With those thoughts, it's time for section 2. Check out that cool graphic. I love it. It's time for us to share some economic forecasts for 2023. Now, remember, these are not real estate forecasts, but most of the real estate forecasting later in the presentation, it's actually based on these critical economic forecasts. Here's a sobering chart. What this is saying is that that green dotted line is the point at which GDP, or gross domestic product, does not cause inflation. It doesn't cause any inflation. In other words, most economists believe that we have to get from the red line, see that red line, which is our current GDP trend, all the way to the green line. That's a 2% fall in GDP. That is a lot. That is a whole lot. While we do see encouraging signs that inflation is going down, there's no past precedent. Remember this, no past precedents of inflation falling sharply without a sharp decline in GDP. In other words, if you're thinking that somehow inflation will keep declining without a sharp reduction to GDP, what you're saying are those four famous last words. This time it's different. We don't believe this time's different. You can get inflation from 9% to 6% with interest rate cuts. But to get it from 6% down to 3, down to 2, we believe that economic activity or GDP has to fall a lot. Ergo, a recession is still a certainty in our view. Now, the Fed knows that they have to go to infinity and beyond, just like Buzz Lightyear. On the left, you can see the chart that shows rate hikes. On the right, you can see the Fed's latest projections. Today, the Fed funds rate is around 4.25 to 4.5. It's a range in case you're wondering, right? The Fed projects further rate hikes this year and no drops. They project its rate to be somewhere around 4% by the end of 2024 and down to 3% by the end of 2025. This is so important that I have to repeat this. The Federal Reserve expects to go up another 3/4 of a point from here. Then they expect to hold there for an entire year, no drops. And then they expect to drop the rate by only 1 point by the end of 2024 and only one more point by the end of 2025. Ouch. Ouch. This is why we believe that what JP Morgan is saying above is likely to happen. In the first half of 2023, we expect the S&P 500, this is JP Morgan, to retest the lows of 2022. It's been a while since we beat that low. As the Fed over-tightens into weaker fundamentals, this sell-off combined with disinflation, rising unemployment, and declining corporate sentiment should be enough for the Fed to start signaling a pivot, pushing the S&P 500 to 4,200 by year-end 2023. Just so you guys know, as of today, the S&P 500, it closed at 4060 at close today. So after a 20% decline last year, JP Morgan only forecasts a 3% gain in the stock market this year. Just 3%, folks. So if you're a real estate investor, please read the tea leaves. 2023 is not a recovery year for real estate or for the stock market. It's sideways with the distinct possibility of a recession. All right, let's look at unemployment. Well, the Conference Board's economic forecasts show a pretty strong Q1 this year. That's what we're seeing. But then they expect unemployment to start dropping pretty fast, or actually start increasing pretty fast and end up a whole point higher at 4.5% by the end of the year. So the big question becomes, is there a downturn projected where, when that number spikes up in Q3 and then to Q4? And the answer is yes and no. While real GDP is indeed forecasted to be negative for Q3 and Q4 of 2023, you see that here, you see that here, it's not going to feel like a recession at all. It's extremely shallow. It's projected to be very short. So it's about as painless as recessions get, according to this forecast. And we looked at a bunch of forecasts, by the way, and most economists are in a similar range, close to these unemployment and GDP forecast numbers. So some good news there. All right. Done with the dense economic stuff. Now for something much more interesting, real estate. We'll do a quick 2022 flashback, and then we'll get to the business of forecasting single family and multifamily performance in 2023 and beyond. Let's start with single family home prices. So US home prices started falling in June last year. By October, they were down to 2.4%. It doesn't seem like a lot, but we're just getting started. We know that this drop accelerated in November and in December, but we don't have numbers yet. My guess, we've dropped about 5% since the June peak. Why do I think prices are continuing to drop? Well, because we don't have price data, but we do have pending home sales data. And as pending home sales continue to fall, we're much more likely to see discounting. Now, as the two talking heads on the screen point out, the West Coast, especially California, getting hammered. And the Midwest, the Rust Belt, looking just fine because their home prices were cheaper to start with. There is no shortage, of course, of shills and delusional bullishness. Here's an extremely bullish interview with the lead economist at Realtor.com. It's very recent. Check it out.
You predict home prices will continue to rise, but at a slower rate. Why aren't prices dropping?
So we have seen some slowdown in home prices. A lot of that is in line with what we see seasonally, and some of it is a little bit more extreme. But one of the reasons we haven't seen a faster slowdown in home prices is because even though we've seen a big pullback in housing demand in the face of high prices and higher mortgage rates, we've also seen housing supply pull back. A lot of existing homeowners have decided that they don't want to sell their home in the current market conditions, which are considerably slower than we saw during the 2021 and early 2022 frenzy that we saw in the housing market. And so that pullback in supply has kept demand and supply relatively balanced and kept home prices relatively elevated. Our listing price data in the most recent month and weeks have shown that list prices are still up double digits compared to 1 year ago.
Wow, so much Kool-Aid there. She's practically bathing in Kool-Aid. So every year we show you home price forecasts, but this year we did not want to be accused of cherry picking. So believe it or not, we spend days coming up with 21 different forecasters. This is an enormous amount of
Wow.
data, by the way, 21 different forecasters. And the range, as you can see in green, is from 5% price growth, that's the Kool-Aid people, realtor.com, all the way down to a 22% price drop, that's John Burns. Now, only 4 of these 21 sources predict price hikes. 17 of them predict declines. In other words, no one really has a freaking clue. But we're pretty sure home prices are not going up 5% realtor.com. So please stop drinking the Kool-Aid because it's clearly rotting your brain. Now, very important to say this, home prices not falling everywhere. In fact, as you can see, they're actually not falling in the majority of the country. Look at the map. Blue means no drop. Red means a drop. The darkest red is 10%, and the table on the right shows 10% in only one city, Austin. The most recent data this week, by the way, shows one other big city is now at 10%, San Jose, California. Now look at the map again on the left, and you'll notice that the red is all along the western side of the US. So Washington State, Oregon, California, then Nevada, Arizona, Utah, and Idaho. We're also seeing declines in Texas, mostly in Austin, and in some small Florida cities. So you look at this chart and might start making people nervous about real estate. But while this chart is factual, it's extremely misleading. Because here is the actual reality of real estate. All blue. Home prices absolutely exploded post-COVID with massive increases in every state in the country. Just to give you an idea of how massive some of these increases were, we just saw Austin has dropped 10% since June, is continuing to drop. But the orange bar shows how much Austin went up in 2 years, a staggering 75%, an all-time record, by the way. Even after retrenching, let's say 20%, they'd be 57% higher. So even if Austin and Phoenix continued to give up their gains and kept giving up more gains, they'd still be 40 to 50% up since COVID. And that is a stunning gain. And this is why none, not one of the 21 forecasters that I just showed you are projecting a housing crash or projecting foreclosures. Home equity in the US is at record highs, and even if prices decline 10 to 15% per year, they would still be massively higher than pre-COVID. So by now, you're wondering, Neal, okay, fine, housing recession, but not housing distress. I get it. What's my opportunity, Neal? Is it just that I'm buying a dip? No, there is a larger opportunity, and this tweet will show it to you. Ali Wolf is chief economist at Zonda Research, and she recently tweeted, our data is now capturing a 70% cancellation rate in Phoenix. She's talking about single family new construction home contracts. 7 out of 10 buyers are walking away from their deposits to buy a new construction home in Phoenix. And that tweet brings us to the opportunity for you, the real estate investor. Now, every investor knows that we have a shortage of housing, somewhere between 3 and 5 million units. And if we don't want that shortage to get even worse, we have to keep building houses at a certain rate. And if we don't, we'll continue to make the problem worse and rents will keep spiking in the future. Except when interest rates are high, buyers stop buying new single family homes. They're the most expensive in the market, right? The nation's big builders are all reporting quarterly results and they are sharing catastrophic data. Home buyers are canceling 50%, 60%, in some markets 70% of the deposits that they put down for new construction single family homes. And you can see the impact of that on the screen in the blue line. far right of the graph. So home building in the US has already plummeted 32% already in the last 5 or 6 months. And we think that Q1 data is going to show another massive decline. Home builder confidence, which is shown in this dotted red line, went from a confidence rating of 90 a while back to 30. 30 is a panic rating, only seen once before during COVID. It's that bad for builders. And that, folks, is your opportunity. If we build hundreds of thousands of homes less each year for the next 2 years while rates are high, we will increase the shortage in the US by a minimum of 500,000 homes. And where will these families go? They'll rent. And rent is all that investors care about today because rent equals cash flow. Which brings us to the most important slide in this presentation, by far the most important. You want to take a snapshot? This is your slide. As a landlord, as a rental investor, we intuitively understand that if the monthly payment for a home is lower or equal to the rent, then people will buy homes. And if the monthly payment is higher or much higher than the rent, then people will not buy homes. They'll choose to rent. So every real estate investor should be obsessed with knowing where the rental payment versus mortgage payment dynamic is to figure out if they should even invest in real estate. And today, my friends, that dynamic is massively in favor of landlords. Massively. Look at the chart on the right. Look at this gap between rents and home prices, right? This is median rent, this is median mortgage. This is the highest in history. It's higher than 2005 and 2006. Now, even though this green line, the rents, you show this huge spike in the last year, but look at this spike in mortgage payments. This is so much higher because there's a combination of much higher prices and much higher interest rates, making it absolutely the worst time to buy a home in history. And smart investors, they know this. So big investors, they're doubling down to buy apartments. That's the dark blue line. And with the work from home debacle, they're no longer interested in buying office building. That's the red line. With the explosion in e-commerce, the other asset class that investors are buying in is industrial warehouses, the light blue line. But understand, the apartment industry is more than 10 times the size of the industrial segment, and it's still growing. Look, it's still growing at an absolutely spectacular rate. Why? Because those investors know that single family construction has already crashed over the last 6 months, and it's going to end up creating a supply hole over the next 2 years, which is going to create millions of forced renter families. Forced renters. All right. These savvy investors also know this critical chart, that history clearly shows that when inflation spikes, rents spike. The left side of the chart shows the dark blue line. Now you can see that in the inflation spike from 1974 to 1984, that led to a decade of massive rent increases between 6% and 12% a year. That's 3 to 6 times the historical average. Now notice, just as quickly as inflation dropped in 1985, rent growth dropped. It dropped into the 3% range, and it sort of lived in that range for more than 3 decades until COVID, until work from home and inflation. It drove rents up to a massive, shocking all-time 15% high in 2021. Savvy investors know that inflation cannot be killed quickly. It will linger for years, which is why they know that we have above trend rent growth in front of us. Maybe not in 2023, but in front of us. And we just showed you a couple slides ago that apartments are the favorite asset class for institutional investors. But these gluttons, they can't find enough apartments to buy. So they're now buying up single family homes. In 2022, institutional bigwigs owned 700,000 single family rental homes. Guess how many they're going to own in only 8 years? They've already allocated money. 7.6 million, a more than 10x growth. Let me repeat that, 10x growth in 8 years. They're coming for you, Mr. Landlord, and when they attack with this kind of aggression, this kind of money, they will end up driving up prices in 2025 and beyond. So I think it's good for you to know where these big investors are buying. Well, every institutional investor looks at the annual U-Haul report, which shows where people are moving to from California and New York. The list is on the right. So Texas and Florida, champions for a decade, but South and North Carolina racing up the charts. Tennessee and Arizona holding their positions. But look at Georgia, particularly Atlanta, up 23 places. The big surprise is number 9, Ohio. It's a low growth Rust Belt state, but it's now benefiting from the return of manufacturing to the US.
Wow.
Amazing numbers, right? And I don't know why they added this audio. By the way, this is a trends
Sounded
presentation.
like what
So
I just said. Wow. You said, oh.
because this is about California, I have to keep sneaking in trends through the bigger narrative. So after 5 years of being laughed at, I can tell you that my California clients, no one's laughing at me anymore. I've been telling them this foreign immigration that's been hiding California's mass exodus is going away. Trump, he was aggressively anti-immigration. Biden administration hasn't changed much. And so now California is not just losing its biggest companies, it's losing its people for the third year in a row. And this is going to continue, folks, for years. Megatrend. And of course, no analysis of real estate is complete without multifamily forecasts. Well, we found the various multifamily forecasts to be actually fairly consistent. So we're using Freddie Mac's forecast on the screen. Freddie Mac saying that with high inflation, there should be positive rent growth in 2023. Remember, high inflation equals high rent growth despite affordability challenges, despite a potential recession. So they see gross income at multifamily properties going up by 3.5%. And they see the vacancy at multifamily properties going up just a smidge from its current level, which is just under 5%, to 5.1% by the end of the year. Rent growth is expected to be fairly strong at almost 4%. Though keep in mind, 2021 and 2022 rent growth was shockingly high, so this doesn't look very nice. Lastly, they do warn that construction levels in the multifamily industry are not falling as quickly as the single family market. So do expect downward pressure on rents from new construction, especially at the end of this year and throughout 2024. Freddie Mac expects that income growth will be strong in Oklahoma, with both Oklahoma City and Tulsa in the top 3. Otherwise, the income growth charts are dominated by Florida cities with West Palm Beach, Jacksonville, Tampa, Fort Lauderdale, Orlando, all expected to see strong but single-digit rent growth. And then on the right side, note that all the cities in the red list, they do have positive rent growth, just anemic. It's in the 1 to 2.5% range. So no cities in the US are expected to see negative rent growth in 2023 in Freddie Mac's forecast. And so I'm going to end this section, my real estate yesterday and tomorrow section, with 2 important thoughts. First, remember this. We need 4.3 million more apartments by 2035. While I still expect price declines in apartments in 2023 because of high interest rates, nothing changes this need. Once the economy corrects, 2024, 2025, whatever, and inflation drops, we still have a huge shortage. Doesn't change. Don't forget that. And here is my second and final thought on real estate. This table is stunning because it shows the income change needed to buy a home just over the last 2 years. In Tampa, Florida, you need to make 123% more to own a home today compared to 2020. Your salary probably
Wow.
went up 10%. In Austin, you need 116% higher salary compared to 2020. You probably didn't even get to 16% higher, let alone 116% higher. And if you think I'm cherry picking cities, just ignore all of the rest. Just look at the last line in green. That is the United States. And you need an 88% increase in your income, in your salary, compared to 2 years ago to own a home. This is devastating. This is mind numbing because an entire generation of Americans, over 30 million families, will never buy a home. Never. And while I see this as one of the greatest tragedies of this generation, it's also obvious to me that this is one of the greatest opportunities of this generation for landlords. The question is it obvious to you? All right, it's time for the shootout. This is where we compare a bunch of different cities. But before I do the shootout and share the annoying music again, let's spend 90 seconds on opportunities that you can participate in with UGrow and with Grow Capitus. Let's start with value add projects. Now, you saw the gap between median rents and median home payments, highest in history, in favor of rents. You saw definitive, undeniable proof that 30 million American families will never be able to buy a home. Knowing that, And knowing that rents go up faster when inflation is high, it makes sense for us to buy existing multifamily properties and improve them wherever we can find them at good prices. So we have value add projects available, and you can get information by filling out the poll at the end. Select option 1 on the second question in the poll. But we're only buying 1 to 2 value add projects a year. And in many markets, value add prices are still far, far too high, abysmally high. And in those markets, it makes a lot of sense to build a brand new asset than buying a 40-year asset. So we're continuing to build apartments in several metros like this one. This is in Utah. You can get information about open projects through the poll at the end of the presentation. Just select option 2 on the second question. And now everyone pay attention. If you're a savvy investor, you know this. There are 0 value add projects in the US that anyone is buying today, now, that will cash flow in the next 2 years. The interest rates are too high. And if you know that and you're a cash flow investor, you should look at the most amazing offerings that we've ever put out. So in the next 3 months, you will see an offering that pays you somewhere between 11 and 14% cash flow, monthly cash flow, immediately upon investment of your funds into a property, and still gives you the ability to get some back-end profits. No one in our industry offers 11% monthly cash flow, let alone 14%, with an equity kicker. So we do expect this product to be sold out immediately on launch. So if you're interested, definitely answer the poll option 3 on the second question. And I have been waiting for years to be able to talk about this slide. Look, not every investor wants syndication investors. Some investors just want to buy property for the long term and never worry about depreciation recapture. Well, for the first and last time in our history, you actually have the chance to buy 3 properties from us, 3 completely different completed rental products in 3 different cities. So first on the screen, finished and leased up rental townhomes. You can buy 1 or more. They are in Raleigh-Durham Metro and come with a interest rate fixed for 2 years. Second, you can buy finished and leased up duplexes. We've got 1 of these left. And out of 66 units, the duplex is in Idaho Falls and comes with an interest rate fixed at 5% for 2 years. Or you can buy absolutely gorgeous rental fourplexes at the university in Houston. We've got 4 units in 1 building and we have 2 buildings left. Take a look at these pictures on the right. Note that these are all real pictures. They're not renderings. If you love open houses, you can actually check out all 3 of these products at our upcoming virtual mega open house. This is a live open house. We'll be actually walking through the properties, showing you the inside and the outside of the properties. We'll answer questions about rents. It's just a lot of fun for those that love open houses. We are unlikely to ever offer these kinds of opportunities again. So if you don't know about these unique opportunities, you want to learn more, or you just like going to open houses, please indicate interest through the poll option 4 on the second question. And done with that, time for the shootout. My team loves these corny graphics, and so do I. Remember, these are not our selections. You know, those come in Neal's pick at the end. What we do in the shootout is we share some of the top 10 lists that have been published by credible sources. Then we make snarky remarks about some of them that are just weird. This year, the lists are so weird that almost all of our remarks are snarky. We start our best cities list with Realtor.com's list of top 10 housing markets positioned for growth in 2023, and we immediately have a WTF moment. Why? Because all 10 of the cities in our first chart, all 10 of them would have a near 0 chance of ever making it to a top 10 list in any kind of normal year. That's how bizarre things are right now. You know, we talk about investing in, fast-growing cities, great population growth, great job growth, long-term fundamentals, yada, yada. Well, they're completely missing from this list. In fact, only 1 of the cities, that's Worcester, MA, number 4 on the list, had population growth faster than 1% in the last decade, 1% a year. All of the rest had meh population, meh job growth, close to even lower than the US average. In fact, 2 of these cities, Hartford at number 1 and Toledo at number 10, committed the cardinal sin of investing. Lost population. Toledo lost a stunning 17,000 people in the last decade. So what the heck is going on here? Well, here's a clue. There's only one word that matters in 2023. affordability. Remember that. Knox list is more what we're used to. Look at that. Look at that. Look at that. Vegas, Phoenix, Austin, Dallas, Denver, SF, Salt Lake. All of the usual stars are here. But wait. This is the list of fastest cooling markets? So all of the hottest markets from last year are now buyers markets. Buyers markets. We're in the upside down here, guys. Whiplash. I repeat it. There's only one word that matters. It's not job growth. It's not what's happening in a market. It's not even U-Haul. It's just affordability. And everything on this list is insanely affordable. So the big question is, how long are we going to stay in the upside down? Because given what we know, we really cannot recommend a city from the first list, the Realtor.com list, with one exception, Grand Rapids. So to figure out what happens after the market corrects, let's look at a list that's a new favorite of ours. Which cities in the US are likely to benefit the most from manufacturing returning to the Americas? Note that I said Americas, not US, because a lot of the manufacturing is actually going to come back to Mexico. And here's that list. Now we see a lot of the usual suspects in the list, and all of these superstar cities will benefit. San Jose, San Diego, San Francisco, Nashville, Portland, Raleigh, Durham, Phoenix, Austin, San Antonio, the usual superstar. Now there are three notable cities that I skipped over: Grand Rapids, Michigan, Detroit, Michigan, Tulsa, Oklahoma. Now we will not recommend Detroit to investor because it loses population. We're watching Tulsa, Oklahoma very closely because it now has strong population growth just in the last 10 years. But except for this one list, it isn't in any top list yet. We're still watching. We like it. But that leaves us with Grand Rapids, Michigan. So over the last 5, 6 years, Grand Rapids has been a very strong performer, sometimes staying just outside the top 10 in many lists. But as you noticed, it was at number 10 on the Realtor.com list. It was the only city in that list that we would recommend. And here it is at number 1. We also want to note that the city did not see massive home price increases in the last 2 years, so housing is relatively affordable in Grand Rapids. We recommend Grand Rapids to investors. You may also want to look at Tulsa, Oklahoma. One final list. This is from Realtor Magazine, which is published by the NAR, the National Association of Realtors. They give the nod to Atlanta as the best housing markets. Amongst small markets, note Rogers, Arkansas, Greenville, South Carolina, and also Jacksonville, Florida. It's also good to see San Antonio in both lists. All right, done with the city lists. You now know what the quote unquote, experts think. It is our long-standing tradition to finish the trends presentation with me sticking my neck out and making 2 predictions. I picked the best up-and-coming market in the US first. These usually tend to be smaller markets that I think have lots of potential. And then I pick what I consider to be the best market for real estate investment in 2023. And I can tell you this, if this year's best market does anywhere near as well as my 2022 best market pick, Tampa, Florida, then I will be absolutely delighted. All right, ready, Anna?
I
First
am
up.
so ready. Love
First
that pick,
up.
by the way.
Yeah, best up. This is the best up and coming market, and it is Jacksonville, and it beats Grand Rapids, Michigan. It's got
That's
strong fundamentals.
Very
It's got an
strong.
excellent affordability score. I love that. High population growth. They all support continued growth. Home prices not as out of whack as many major markets. So price declines will happen in 2023, but they're likely to be fairly modest. A lot of it will get done in the first half of the year. So look to buy. If you're looking to buy in Jacksonville, look to buy it late in the year. And now it's time for the market that I consider to be the best market in the US. And I'm very excited because this one's missed many times, and it is Atlanta, Georgia. So it is a finalist several times before, and Atlanta beats Charlotte, North Carolina by a nose. Affordability. That's what makes Atlanta the winner this year. Amongst fast-growing superstar cities, Atlanta is the only one that's affordable. The only city that's affordable. It's got the highest housing affordability scores. We're tracking very strong inward migration. We're tracking a very fast-growing tech industry and consistent population growth. So we think Atlanta will continue to attract investors. Once again, we do expect price declines. We expect them to be fairly modest, maybe in the 5%, 7%, 8% range. and mostly in the first half of the year. So start looking at Atlanta in the second half of the year. And those are our top two picks. That's our show today, folks. We hope you liked it, but what you learned today, it's a tiny, tiny fraction of the incredible and free knowledge that's available on multifamilyu.com. We will be posting hundreds of reports that were the basis for this presentation in our real estate trends toolkit on multifamilyu.com, and we'll send you an email when it's posted. We're planning 20 webinars this year, so keep coming. Um, now, please note that I want you to answer the poll. This is very important because it helps us understand what it is that you're interested in. The poll's up on the screen. Remember, it has 3 questions, not one. So we want you to answer all 3 of those questions. And we are now happy to take your questions. Feel free to throw your favorite city at us if you didn't see it in the presentation.
Oh my goodness. What a power-packed presentation.
That was fun. That was incredible
Yeah,
amounts of fun. I
my
know
goodness.
there's 637 of you watching, and hopefully you got something out of it, but there's still unresolved questions. I felt like this was the one year where I should just break it up into 3 pieces because there's so much to go through. So I'm hoping that I can actually resolve some of the stuff that I didn't get into the presentation through your questions. I think that there's important questions that all of you should be asking us. So yeah.
Absolutely. And you can count on our audience to do that. So let's start with this. Um, so some people say while there are still as many people who need housing, we have a decrease of household because people might be renting with friends or go back to living with parents during recession. This will decrease the rental market. What do you think about that?
I think that's absolutely 100% right. And in fact, it happens every recession. So a lot of people say we need 3 to 5 million homes in this country. The short answer is we don't. We need 3 to 5 million overall. But the number of houses that we need is dependent upon a number that economists track called household formation. Every time the economy goes into a recession, household formation turns negative, which means that people do exactly what you're saying, sir. They or ma'am. They basically go live with grandma, they go live in someone's basement, they go live in a car, and when that happens, the demand for housing falls. And usually what that means is rents become flat. Sometimes they even go negative, but it's very uncommon for rents to go negative in the US. Even in 2009, rents were only rent negative for about a year before they went back and became positive. So negative household formation is not just something that happens from time to time, it happens all the time. But here's what happens when recessions end and unemployment goes down, jobs get better, people start getting raises, we usually see the trend go back to where it was. So household formation goes downwards and then picks up and it stays on that original trend line. So you have to keep in mind that the trend line's still there. Your argument isn't in any way affecting the trend line, but yes, during a recession, you're right. There's going to be a lot less, lot less rental units needed. Maybe about 500,000, maybe even 1 million, and that's why often you see rents dropping. Now, why aren't they dropping this year? They are dropping because inflation, if it's at 6%, I, by the way, don't believe official inflation numbers. I think it's a couple percent higher. So let's say official inflation's at 6, unofficially it's at 8. If rents are at 4%, you realize rents are at -4. If inflation's at 4, take a look at the 30-year historical trend. Rents are usually a little bit above that. It's, if inflation's at 6, rents tend to be at 8. But what I'm saying this year is inflation, when you count real inflation, might be at 8, and rents might be at 3.9. Doesn't that mean that rents are actually half of inflation? Doesn't that mean that they're actually negative? They're nominally positive, but real rents are likely to be negative.
Um, Here's the next one. Will the explosive growth in apartments vary by property class? So A, B, C. Can you speak to that, please?
Sure. So typically at the beginning of a recession, Class A tends to start offering a lot of discounts. They tend to lose occupancy. Um, Class B and C, so people will downgrade. Some people go from A to B and then B to C. So a lot of people assume that because this happens, everybody knows, people downgrade. They think C is the best class during a recession. There's actually no data to support this at all because C has the most delinquency. A typical American living in a Class C apartment complex has $400 in the bank. A typical person living in a Class A has tens of thousands of dollars in the bank. So keep in mind that the person that's living in Class A is less likely to default. They might move down to B, but they're less likely to default. But we see delinquency pick up for Class C. So while occupancy tends to stay highest for Class C, delinquency basically means that net operating income at Class C tends to drop more than B. In general, for a recession, Class B is easily the best and tends to get through the best. A's lose occupancy, often it drops down to 91, 92, but then their occupancy picks up very sharply as soon as recessions end. A perfect example of that is to look at Class A, Class B, and Class C occupancy in 2009 through 2010, and you'll see the exact trend that I just showed you.
Awesome. So can you give us some insight on what appears to be negative population growth, or at least stagnant population growth, overall in the US? Even through the news media would make the news media would make you believe that we have an overpopulation problem. So
Oh no, the US doesn't have an overpopulation problem. I think most countries in the world have underpopulation problems. China is an absolute disaster. So is the Eurozone and most of the Eurozone and Japan. The US is basically producing 1.9 babies for every 2 adults. So we're below replacement levels. So anyone that at this point believes that we have an overpopulation problem is delusional. The US is beginning to not replace its children, which means that our population will start to shrink in the 40s and the 50s. Luckily, not a problem that we have to deal with in the next 10 or 15 years because we still have basically a bunch of people joining the population, and the people who care, who matter the most in the population are really adults, and that population is not going to drop for a while. The population of young kids is dropping and is something that we should worry about. But absolutely no one should be worrying about overpopulation. That makes zero sense.
So should we avoid buying multifamily in the first half of 2023? If yes, why is that?
Yes, that's our advice, and I might even modify that to say you may not want to buy them for the first 3 quarters because I think that as single family prices decline, as interest rates continue to go up, there is going to be significant pressure on multifamily. You're also going to be paying top level interest rates. Now you might say, yeah, but didn't you just say that the Fed's not going to drop interest rates for this whole year? But it's not the Fed that's affecting your interest rates. Let me give you an example. You want to get a bridge loan for your multifamily property. Today, you have to use a measure called SOFR, and SOFR is probably around 4.5%. So that shows you the Fed funds rate, right? The Fed funds rate is about 4.25. SOFR is right around there. So that's the Fed funds rate. But that's not what you're paying, because on top of that, there is something known as the spread. And in normal times, the spread is 1%, 1.5%. Right now, it's 4%. Now, the spread is just fear. That's the banks being afraid because they don't know where the Fed is going to go or how long the Fed's going to stay there. Let's say by June or July, as we are predicting, the Fed says, okay, we've done enough. We're just going to skate along at this level for the rest of the year. We're not looking to drop rates, blah, blah, blah. Well, guess what happens? The bottom part doesn't change. The Fed's still at that 4.5%, 5% range. But the top half, the fear now goes away because everyone knows we've hit the top. And then the spread collapses. And all of a sudden, if you have a property in contract in July or let's say August, and you manage to stretch that sale out, so you close in December, by the time you close in December, the spread has collapsed and you get a huge benefit in your interest rate.
Can you talk about affordability with rents increasing? Are incomes going to support the high rents?
So affordability in the US for rents, and I have charts on this and it might take me a while to find them. So overall affordability for renters is about 30%. Now it is the highest it's been for a long time. 20 years ago it was a little bit higher, during the dot-coms. But 20%, 30% is not considered to be outrageous rental affordability, right? Also, please note, this is very important. Last year you had a good point because if rents go up 12%, salaries go up 4%, obviously that's not going to last. But what am I predicting this year? I'm predicting a 4% rent growth in a year where salaries are going up 6. Currently, salaries in the US are going up 5.8%. I know that doesn't last. But if inflation doesn't come down rapidly this year, which I'm not projecting, salaries might still be 5% higher than 4% higher than 3.5% higher. And if rents are 3.5%, there isn't really a disconnect there. There really is not much of a disconnect. There was a disconnect a year ago where rents were going up 15%, salaries going up 6%. So you don't have that much of a problem at the moment.
So, Neal, please circle back to cash flow.
Mhm.
Ask this investor, will we see multifamily difficulty in cash flowing? And can you differentiate between new construction from existing acquisitions? And are small projects, less than 10 units, more at risk?
I think everything's at risk. So I don't believe that multifamily will have cash flow for this year or for next year. Sure, if you invested in a property 2 or 3 years ago, things are different. But let's say you invested in a property 18 months ago, 12 months ago, 6 months ago, today, 6 months from now, 12 months from now. I don't think you get any cash flow in 2023. I don't think you get any cash flow in 2024. Why? Because the property isn't
Yep.
doing anything wrong.
Okay.
It's doing its job. The property is generating a very reasonable net operating income. But then every single dime of that is going into your mortgage. So in that kind of environment, it's very difficult to generate cash flow. Also, the banks are afraid of this. So guess what they do? They don't give you a 75% leverage. They don't give you 70. They give you 60. When they give you 60 leverage, guess what happens? You need more equity. So a bunch of investors like you are now putting money in. So if there is cash flow, it now has to be divided amongst a bunch of investors. So for those two reasons, you're not going to get any cash flow in multifamily, smaller or larger, at least for the next 1.5 to 2 years. We'll see what happens. But that's a reality. And I'm not suggesting that I'm any better. I'm not suggesting that my projects are any better. What I'm pointing out is that all of these bizarre disconnects in the system actually increase demand for rental housing. 30 million people, 30 million families that could have bought single family homes in 2019 can't buy them today. So they're going to end up becoming renters. Is it going to help with rents in 2023? Probably not. There's a recession coming. But will it help in 2024? Probably yes. Will it really help in 2025? Hell yeah. So eventually, when the economy recovers and there's all these people that were going to be owners and are now renters, it makes the shortage worse. But don't expect this to make you cash flow in 2023 or in 2024 for smaller or larger properties. Now, the question was multifamily new construction. Well, that's an easier one to answer. If
Yep.
you're investing in new construction today, you're not going to have any cash flow for the next 2 years anyway. And by the time the property is built, even the Federal Reserve, which is the most bearish, is expecting interest rates to come down. So once that property gets occupied, then it can refinance at 5% and give you cash flow. So I think straightforward answer.
Yep. So, Neal, let's talk about cap rates. We have a few questions here. So, Bob says, no mention of decompression of cap rates. 4 cap that moves to 5 cap means a 25% drop in value. Another person says, Ed says, do you expect cap rate expansion in 2023? And if yes, by what amount?
I should have put a slide in there. It's just a
Yep.
matter of time, but I'm glad that question came up. I think that's a very important question.
Very,
I know
very
some of you
important.
don't understand cap rates, but a lot of our audience cares a lot about cap rates. Cap rates have already decompressed. The people that are saying that they haven't decompressed simply aren't keeping in touch with the market. Class C properties were selling at 3.5, 3.75 cap, let's say 13, 14 months ago. Those properties are now selling at 5.1 cap, 5.2 cap. Decompression has already happened. This is the most important part. We do expect decompression to continue as the Fed raises rates further. You should see 5.2, 5.3 cap. You might see some properties selling at 5.5 cap before it gets better. But understand this. The fundamental demand for multifamily is massively higher. One, because of those 30 million families. Second, because of the fact that nobody likes office anymore. Nobody likes retail. Nobody likes hotel. Everyone wants to pour into multifamily. So we expect cap rates to peak out somewhere around 5.5. When does that happen? Probably close to the end of the year. And then we expect them to start to decompress because it's a favored asset class and it has tremendous long-term benefits. As the Fed starts to bring interest rates down, we'll definitely expect decompression, but it won't even wait for the Fed to start bringing rates down because we don't believe rates are going to come down this year. Fed's going to stay at a plateau. but rates will come down when the spreads start going down. So right around maybe August or September, when people start feeling, okay, the Fed's not going to raise anymore, the fear in the market goes down, spreads come down. As spreads come down, interest rate, your mortgage rate comes down. So you can start to see some decrease in cap rates or increase in prices in maybe December, October. So it's hard to tell when it happens because there's two different things pulling in two different directions. The Fed's raised rates, but the fear is down. One part makes prices go up, which means cap rates go down. The other one makes prices go down, which means cap rates go up. So there's going to be a fight here, but I think that lower cap rates will start to win in 2024, right? And they will start. I believe cap rates will continue to decline back from that peak of 5.4, 5.5 for Class C properties. I think most of you asking are interested in Class C, down through the fours through all of 2024. Do we end up in the threes? I don't believe so. I think that was madness. I never think that time comes back. But we could see 5.5 to 4.5 by the end of 2024.
Awesome. So here's another question. Will there be a flood of deals because originally these acquisitions were done, the current acquisitions were done via bridge debt, and there will be difficulty in refinancing, or as we know, the cap rate locks to, those are an issue too. So is rescue capital being talked about quite a bit these days? What are your thoughts about this?
It's early. So, I mean, I've studied 2008. It takes a long time for these things to go bad, and there's multiple reasons why. So, there's properties that have rate caps that haven't been hit yet. There's properties where they're just beginning in the last few months to start seeing a pressure on their operating reserves. Some of the properties, the syndicators will step up and put their own money in. That'll get them by another 3 or 4 months. Then they'll go back to the banks and ask for a few months of rent forbearance. Some banks will say yes. So it takes a while. Then they'll go to their investors, do a $2 million capital call. Maybe they end up with 600,000. They spend that money, that gets them another 2 or 3, maybe 6 months, maybe even 12 months. So it takes a while. This is a slow moving process. Also, the problem is a lot of the people that follow us are basically from the syndication world. And the syndication world thinks that it is the multifamily world. You're not. You're 5% of the multifamily world. The remaining 95% are a bunch of fat cats. They can afford to put money into their property for years for one simple reason. A lot of their properties, they are fixed rates, so they don't have as many issues. So some of their properties that are not fixed rate, they can put money in. They're very, very rich. And they don't have some of the syndication issues that we've seen. So keep in mind the syndication industry is between 5 and 10% of the multifamily market. Let's call it 10,000 properties. Okay. Out of those, 1,000 properties come to market. That's not a flood because it's a very large market. Are there going to be a significant increase in distress from a percentage perspective? Sure. Does that somehow become, large enough to create contagion in the marketplace? No, I don't believe it does.
Okay, are you ready for a shootout?
I'm ready.
I'm gonna be firing markets at you.
Sure.
All right. First of all, why Port Charlotte?
Um, well, the short answer is we like Fort Myers, and Port Charlotte is just an adjunct. We look at Port Charlotte. This is a property that, a place that we're building at, and this is meant to be a long-term property for Anna and I. It's a large investment that we've made based on our past profits. We look at that part of Florida and we think that the next 10 years are going to be good. Yes, we're going to pay a lot in insurance costs.
Yep.
It's in our pro forma, right? It's in our pro forma. We're going to pay a bunch of money on insurance. You're going to pay a bunch of money everywhere in insurance. Texas insurance has gone up like crazy too. And we're obviously being careful to make sure that if a hurricane ever hits Port Charlotte again, we're in a good place. We looked at what happened with this hurricane. Port Charlotte just took a direct hit. And to be honest, new properties, I mean, roof tiles flew off. Not a big
Yep.
deal.
Okay, Salt Lake City, Utah. What are your thoughts?
I think the overall market is very, very strong, but keep in mind Utah's seeing a negative trend. So we do expect home prices to fall significantly in Utah throughout every city. So Ogden to Salt Lake to Provo will see significant declines in home prices. We don't expect to see panic in that market for one silly reason. Utahns love to buy property and they hate to sell.
Yep.
Whereas in an average market, properties will turn over every 3 to 5 years. These suckers, they keep them for decades. So
Yeah.
if a property comes in the marketplace, they just snap it up.
How about Columbus, Ohio? And do you know anything about Intel there?
So obviously there's a big Intel investment. I look at that. I it's not going to change things. I like Columbus, Ohio. I think most of you know that if there was one city in Ohio that I had to pick, I would pick Columbus over Cincinnati, over Cleveland any day. Definitely pick it over Dayton. So bottom line is it's a good city to invest in. I'm not sure you should be investing in it just because of Intel. A lot of these announcements were made because the feds are throwing money at stuff. I don't know how much of this stuff is going to get actually built in a reasonable amount of time. I noticed Samsung saying blah 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 blah, and at the end of the page it said all the way to 2034. Okay, fine. I mean, that just means that you'll build something, and then 5 years later you'll build something, and 10 years later you'll build something. So this stuff takes a long time. You shouldn't be
Yeah.
investing in Columbus because of Intel, but Columbus in general and Ohio in general is benefiting from the return of manufacturing, specifically
Hmm.
high-tech manufacturing. So I think Columbus will do well.
Killeen, Texas, please.
So Killeen is part of Austin, and the our bet is that as Austin becomes disgustingly expensive, grossly
Yeah.
expensive, it'll do what every other city like it has done in the last 50 years. It'll push people outward. The only city that is inexpensive in a drivable, so people live in Killeen and work in Austin, is Killeen. There are no other options. You can go in the other direction, but you'd have to go 79 miles to San Antonio. I don't think that's drivable. I don't think it works. And the northern part of San Antonio is actually fairly expensive. So what are your options? I mean, all the other cities are expensive. San Marcos is expensive. Kyle, Buda, New Braunfels, definitely very expensive. So where's the cheap option for Austin? Well, you drive north and you work in the northern half of Austin, which also happens to be the richest half of Austin. 45-minute drive. That's our bet. So far, it's working.
Indianapolis, Indy.
I think Indy is a terrific place to invest in. Last year, we were telling people about Indy. We think it's a fantastic market. It definitely, I mean, look at its rail systems. They look at its location. It's perfect for a lot of manufacturing related activities. Um, I also think that Indy actually is fairly affordable, so I don't think that it will, home prices will crash as much as they will in some of these superstar markets. So I think Indy's in a good place. I mean, if you know what you're doing with Indy, keep in mind Indy has very high crime areas, so stay away from those. But good B
We have some
areas in
great
Indy
suburbs.
are terrific.
Yeah.
Yeah, terrific suburbs.
Kansas City, Missouri.
Similar comments to Indy. I think that they're in a very similar place. I think that if you understand Kansas City, I would say I don't like Kansas City, Kansas, but I do like
Hmm.
KC Mo, which is on the other side, on the Missouri
Hmm.
side. I think it's a pretty decent place to invest in. Also fairly affordable, so home prices may not drop much.
Seattle, Washington.
Ah, very very
Awesome
challenging.
place to
So
live.
I know it is, but look,
Great city.
Seattle's really, really expensive. I love Seattle. So does Anna, but I
Yeah.
think it's in a challenging place in terms of home prices. They've gone up so much. I think
Yeah.
they will retrench. They will retrench in a pattern similar to Austin, similar to Phoenix, but not as much as the others. The big reason for that is lack of inventory. So I'm seeing significant increases in inventory in Phoenix and Austin, in some of the other states. I'm not seeing a significant increase in inventory in Seattle. So I think it does well, but price declines, maybe 10%, maybe 15% from peak.
Okay, so we let's talk a little bit about Florida. I've got several questions in here. So I'm going to hit three different areas. Tampa, Southeast Florida, mainly Miami, Fort Lauderdale, and Southwest Florida. So Naples, Fort Myers, those areas. What are your thoughts about that triangle?
Nothing crashes. I think all three of those areas do well. They do better than the US. Florida is just in this halo place right now. So as I looked at the
Hello.
numbers, it is
Yeah.
in a phenomenal place. Um, I'm not very fond of investing in Miami for climate change reasons, but in general, I think Florida is going to do quite well in this recession. In this housing recession, obviously 2008, Florida got butchered. But keep in mind, it also has very long foreclosures. Floridians have gained such a humongous amount in home equity that I don't expect them to be in any trouble. Keep in mind, a lot of my slides showed that most cities that are going to be bouncing upwards, like 50%, are in Florida. So
Yep.
some price, decreases. I think the price decreases actually are in some of the areas that Anna and I are investing in. It's like Fort Myers might see a price decrease. Sarasota might see a price decrease. But you know how much they've gone up? It's sick. I mean, there's a severe lack of rental housing because Sarasota has gone up, I don't know, 60%, some crazy number. So I do expect Sarasota, Fort Myers, Naples to retrench, come down maybe 10, 15%. I don't expect the West Palm Beach to come down as much, maybe 7, 8%. Same problem as Seattle, just not enough inventory to bring it down. So I
Right.
think all of Florida will do well. Orlando might do especially well.
So let's talk about insurance. What do you think about the insurance situation in Florida?
It's bad and will get worse. You have to basically have a truckload of money in your pro forma for insurance. I mean, this, you look at the media, they almost show that hurricane blew away Florida. I mean, it's nonsensical. 25 million people live in Florida. Yes, there were deaths. Yes, there were, people that were hurt. But when you look at the size of the state and you look at the damage that these hurricanes do, it's really insurance. You have to make sure you have plenty of insurance.
Phoenix and Tucson, Arizona.
So Phoenix should retrench a lot. I mean, it went up like crazy. We're seeing retrenchment happen. I think it's down about 7, 8%. I expect Phoenix to go down over 20% from peak. Once again, that still means it'll be over 40% higher than pre-COVID. So the two cities that I expect to retrench the most are Austin and Phoenix, over 20% in each case. Tucson, maybe not that much. It really didn't go up that much. I'd say probably a 15% decline. But I think there will be declines in these markets. I do not expect very significant declines on the rental side because of the remember that tweet that I showed you? If 70% of new construction homes people are walking away from, they have to go rent. So all of a sudden you see a boost on the rental side, which
Yeah.
protects the rental markets from big declines. There have been small declines. Now, Phoenix rents are down about 2%, 2.5%. But they keep in mind Phoenix went up 31% in
Mm-hmm.
2021, which was the all-time
All
rental
time.
increase for any market any year in the US, right? So
Ever.
31% ever. So down 2.5% after 31 increase doesn't really bother me too much. So what I do expect to see is distress in certain multifamily properties in Phoenix simply because they can't make their numbers work. Does that mean
Yeah.
Phoenix will have a distress market? No, that simply means investors are going to lose money and some of those properties will sell at a distress and institutionals will come in and buy them.
And those properties bought late in the market cycle.
2021 mostly. I think most of the properties that will see distress late in 2023 are going to be 2021 purchase properties.
Mm-hmm. Exact existing value add. Yes.
Yep.
Okay, Denver, Colorado, and Colorado Springs, Colorado.
They don't look good. I'm usually a fan of Denver, and in the past, in maybe like 2 years ago, I was very critical. Then I noticed that its incomes were going up, so I stopped being critical. Denver doesn't look good. Colorado Springs doesn't look good. Both of them are showing severe signs of stress and could easily lose 15 to 20% home prices. I don't know any other market there, but these two don't look good at all.
What about Boise, Idaho?
So Boise is an interesting case. I expected it to drop more by now because, as far as I'm concerned, it is the poster child for boom cities, boom towns. I mean, even more than Austin. So I'm a little surprised to see resilience in the Boise market. Having said that, I think it will come down. I'm thinking a 15 to 20% decline in housing prices. I think multifamily already declined there by about 10% and should decline more.
Houston and Dallas.
Houston didn't see as big of an increase, so I don't expect it to see as big of a decrease. It didn't see that massive bounce, right? Dallas is an odd case. So it should be decreasing. It should be decreasing fast because if you look at the Dallas home prices, they're sort of similar to Austin. But what I'm also seeing is that people in Dallas are keeping inventory off the market. So for the moment, it's doing well. It's probably only gone down a few percent. And so we may have an exception case with Dallas here. It may not drop more than 7 or 8%, simply because people in Dallas have immense belief in it. People outside of Dallas have immense belief in it. So it might be the odd case that doesn't drop much.
Okay, finishing up, let's see, Research Triangle area of North Carolina. So Raleigh, Durham.
Sure, Chapel Hill. So I think
Yep.
the area is overall going to do well, but should see some price declines. I think if I had to guess, I'd say 10%. Durham's going to decline less because it went up less than Raleigh. I think overall that is a phenomenal market. So, if there's a 10% decline, you buy stuff. I mean, I think it's an incredible market that'll just keep going up. But you might see, you know, 5, 7% declines. I think it's already declined about 2.5%.
All right, we're moving away from cities, moving back to other types of questions. What type of loan would be ideal for a multifamily purchase in this market in 2023?
At this point, I mean, I think if you talk to brokers, they want you to buy fixed debt at this point. It's
Yeah,
very, very difficult to make anything else work. They want you to buy fixed debt. And so I'm not sure if there's much of a choice at this point.
yeah. Um, so are you expecting any disruptors via new construction techniques or new product popularity like group homes that may impact demand in a major way?
I do. I'm expecting them around 2030. So the short answer is no. So, I mean, I'm seeing what's happening, for example, with 3D printing. I know that these homes that they're building are costing an absolute fortune. It just takes a long time for, efficiencies of scale. Tesla is a perfect example, right? So look at how long it took battery costs for Tesla to come down. This stuff takes a long time. There are disruptions coming to real estate in multiple different ways. None of them appear to be coming in 2023, 2024, maybe not even 2025, because it takes so long to hit economies of scale. I mean, all the modular factories in the US are probably building 5,000 to 10,000 units a year. All of them.
So do you have a presentation coming up that people might be interested if they're thinking about what's coming up?
Yes, so this year, you notice that, we snuck in some mega trends like California, but we have a bunch of mega trends that we decided, no, we can't possibly put all of it in one
Too
presentation.
much,
So
too much.
it's two parts, it's two different parts. So mega trends is a different presentation this year. Now, there we talk about longer term. There we talk about 3D printing. There we talk about ChatGPT, which everyone has got to be talking
Yeah.
about ChatGPT if you want to understand just how ridiculously disruptive this thing is. So we took a bunch of megatrends. Some of them are real estate, some of them will affect real estate, and we put them all in there. The one that I really care about the most is the return of manufacturing. The world is fracturing, so we're going away from globalization towards a
Mhm.
weirdly, you know, um, kind of a block-centric world, just like we had, in the 1980s. And I think it impacts real estate in massive ways.
Absolutely.
I want to talk about a triangle of Mexican cities that are close to the border and how Freeway 35 is going to become critical. All of that is in the Megatrends presentation next month.
Yeah. So please sign up and join us for that. Okay. So as an investor today, where should my money go for the first half of 2023, given it's later in the year before recommending buying multifamily?
It depends on what kind of investment you're making. Obviously, if you're investing in new construction, I mean, why does it matter? You're going into new construction, the property's going to be built this year, next year. It's probably going to get leased up at the end of next year, end of 2024. So it really doesn't matter. New construction tends to be very highly affected in certain cases. Right now, it's not affected simply because you're not delivering anything. So don't don't invest in new construction that's delivering this year. That's bad. But if you're investing in new construction, it doesn't matter. Now, on the value add side, I'm not suggesting that you don't invest. I'm just suggesting that it's better for your money to be in the bank. So I'll give you a tip on that. So we keep our money in a money market account at Comerica. There's no you can withdraw it immediately. The money is liquid. They don't really put it into like stocks and stuff like that. They're essentially doing a very interesting treasury trick. So they're buying treasury bonds, and each day they buy and each day they sell, and whoever wants their money back, whatever bonds they've sold that day, they give it back to you. So we make 4+%. It's pretty awesome. that's what you should keep your money in for the first half of 2023 if you're doing value adds. That's my honest opinion. I think it's just a very difficult thing to do to invest in value adds in the first half of the year. And I have syndicator friends that'll bash me for saying that. I'm sure there are edge cases, but for the most part, I don't think it's a great investment in the first half.
So I guess that would add on to this question. People tell me to avoid 10 to 11% returns plus equity because it's too good to be true. And funds are like putting it into a Ponzi scheme. So would you say that's true in this environment?
In general, it is. You can architect it to make it work, but like in our case, right? I gave you this example, 11%, 11% cash flow. You notice that the IRR was not very interesting. It was 14 or 15%, something like that, whatever was on that screen. So essentially what you're doing is you're front loading your profits and you're giving up a bunch of profits because if you didn't need cash right now, you could have easily made 19 or 20 IRR. So you're moving your cash flow forward and taking a hit on your IRR. When you see those kinds of situations, nothing shady is being done. You're basically, preferring cash flow over higher returns. But in general, I think that I do see some stuff out there that is Ponzi-ish.
Yeah, agreed. Let's see. So I think we're getting close to the end, Neal, and I
Nice.
want you to start looking at the questions.
I'm looking at
Um,
Q&A or chat.
oh, okay. Do you see increases in 55 plus housing in your picks?
I do, but they're going to get hit a lot in 2023. So keep in mind my long-term answer is absolutely yes. Short-term answer, they're sort of in the same situation as the rest of us. So I do think 55 plus housing is good. I don't actually like 55 plus housing in the Class C realm. I like 55 plus housing in the Class A realm. Remember, the boomers are rich. It's other generations that are the problem. Boomers are rich. They had it awesome. And if they choose not to live in a McMansion, if they want to go live in a 55 plus community, and by the way, most 55 plus communities, most people are 65 to 70 years old, just so you know. It's just a fancy word, 55 plus. What it means is they're not getting medication, right? They're fit. So in those scenarios, actually they want to live in nicer properties. I like 55 plus on the Class A, B plus side. I don't like it on the
Yeah.
Class C side.
This is a great question. Do you see that construction costs will come down this year as related to new multifamily projects?
Well, here's one answer where I can be very definitive. So we're building $600-700 million worth of construction in Texas. So this answer is very Texas specific. Definitely in the last 2 or 3 months, we've seen loosening.
Yeah.
Definitely in the last 2 3 months, we're seeing the numbers go down by 10%. Most of that, by the way, is labor because material cost, it declines when it declines. In the end, obviously lumber declined very early, copper hasn't declined yet, so there's still a process, there's still some supply chain issues to go through there. Eventually they'll get worked out. It was labor that was the problem, and until maybe September, October, nobody was really giving us time of day when we wanted a cut.
Yeah.
Now they are. Now they are, for sure. It's down.
So you may have mentioned this before, Neal, but I think it's worth repeating. What are your predictions for when the Fed will pause at peak interest rates?
Around 5.25, and remember they have 3 to 4 potential hikes to get there, and I think they'll get there in the first half of the year. The Fed wants to get there and then stick. I'll tell you why. Unfortunately, every decision the Fed makes has to be based on data that's 6 months old. So they want to get to their plateau and then start looking at the data to determine how to avoid a recession. I'm not suggesting they can avoid it. I'm suggesting they will try. It's easier for them to avoid it, or at least easier for them to try, if they get there quickly. So I think there's a Fed meeting on Feb 1st. They go up 25 or 50 basis points. Then they go up another 25 basis points in March. And then they go up another 25 basis points in May. And then they stick with it. Or maybe they do one final one in June. I don't expect the Fed to raise in the second half.
Okay, Neal, I'm giving you 3 questions. Spin the dial on the Q&A. You've got 3 questions, and we're out.
All right. Let's see. Las Vegas. So I picked Las Vegas as my up and coming market last year. Roy, here's the bad news. I think Las Vegas is going to see a strong decline. It may not be in that top tier with Phoenix and Austin, but it's definitely in that second tier. I expect significant single family home. Since you're asking the question for single family, I expect significant declines. All right. Let's see. Boom, boom,
That's
boom.
1.
That's one. What about real estate in metaverse? The short answer is it doesn't mean much at this point in time, and I suggest you don't invest any money into it, Derek. Let's see. Oh, here's a question, very important. Any changes to projections or forecasts you are making based on recent developments for your own projects? And this question is specific to YouGrow, so the company that we're running. So the answer is yes, Rajan. So there's bad things happening there in terms of construction. So initially construction costs going up, now they're going down. There's the debt is up. But on the good side, we're also seeing rent increases, which obviously we haven't seen much of a rent decline in our markets, Austin, San Antonio. We are going to make changes. We believe that our profits are going to go down, but we don't believe that they're going to go down very substantially. So what you might see, so here's the right way of putting it. Our IRRs might be down. Our equity multiples do not appear to be affected much. Is that fair to say, Anna?
I would think so, yes. Yes.
All right. So that's
I'm
my
going to give
third
you,
one.
okay, so that's your third one. So,
Mhm,
and it's 9, we're 1 hour and 27 minutes in, and I
mhm.
think it's a great time to thank everybody for being here for this incredible event.
Well, thank you, everyone. And thank you, Anna, for being here. Thanks, everyone. More than 600 of you showed up this time. We love having you, and feel free to send us your questions and join us in February for Megatrends. Thanks, everyone.
Megatrends coming up. Thank you, everyone.
Thank you. Bye-bye.
Bye.